Good morning, everybody. Welcome to the Flow Show. It's Thursday, 16th of May, the day after the big data point CPI and everything else yesterday, which we're going to discuss. Morning, Sir K-Man. How you doing, mate?
Hey, good morning, Ryan. Good morning, everybody. Yeah, I'm doing fine. The day after.
Yeah. You have a nice couple of days off?
Yeah, very nice, mate. Had friends over, a bit of family. It was a very, very nice few days. Lots of catching up. And now we are ready to get back into the saddle.
Yeah, very nice, mate. Glad you enjoyed it. Yeah, lots to get through, obviously, today. So let's crack on straight into it. We'll start off with a bit of data and some data out of Japan overnight. GDP numbers, a bit of a stinker, actually. Headline GDP coming in worse than expected on the quarter, down 0.5% versus down 0.3% expected year on year, down 2%. CapEx, that's investment, coming in a negative, down 0.8%. Anything that did really go their way was their GDP price index, or like their PCE, that rose to 3.7%, higher than expected 3.3%. Private consumption, that's spending, consumer spending, also worse on that number as well. Now, you would have probably expected yen to have weakened quite significantly on these numbers, but there's other forces at play at the moment. Despite those numbers looking quite dreadful, as you can see from the expectations, it was expected to go that way. So the fact it went a little bit more isn't that much of a shock. Again, this is Q1 data. Everyone's looking a bit past that to see what happens in Q2 with all these wage rises and Kishida's attempt to create this virtuous economic cycle. So there's probably a half interest in this number, but still it will need to improve in Q2. It's not looking too good there. There was a bit of an improvement in industrial production, though. That was up more than expected, 4.4%, with capacity utilization rising as well. So there are some green shoots in there for that one. Kay, you up to speed on the data? Do we half ignore this GDP?
Yeah, sort of. Yeah, no good data, but we've already been talking about that. That the market is already likely looking at what's going to happen in the new fiscal year, because that's where really things should start to move. In all guns blazing, if there are any guns to blaze. Yeah, it's all like still all temporary. What happens in the end, right? You get a bit of a reaction yesterday and the day before on the dollar, and then those numbers come out. Oops, what is this? Yeah, those numbers come out. I can only say, I mean, that's what happened, and now we're looking forward. The industrial production is a bit of a yo-yo data. They always expect good numbers, but then it usually comes out a bit of a random one. That one. What I not really like in there is still that private consumption. That is really something that should go up in the new fiscal year to measure if the consumer is happy with what's happening with what they've got, and that's de facto going to help the GDP as well if they do. But it's all still very it's all still up in the air, right? We don't know what's going to happen there. I think a lot of what we saw the first hour there in the Japanese session may have been a bit of fixing as well, or and a follow through on a weaker dollar. But then the rebound that we saw since then is quite significant as well.
Yeah, exactly. I think that's probably one of the key areas to watch, the consumer moving forward, consumption, the consumer, retail sales, that sort of thing, because there's no point in coming in with all these wage hikes if people are just going to stick it in the bank. That's not going to get the economy moving. So that's going to be the first signs of whether all these wage hikes and everything is starting to work, is if the purse strings start loosening and the savings gets tapped and people spend more than they save. And that will probably be a big guide as to what's going to happen with BOJ policy moving forward. So we shall watch that over the months ahead.
Absolutely.
Yeah. Economy Minister Shindo said after the data that the economy is expected to continue its moderate recovery. Well, those numbers aren't a moderate recovery in any way, shape or form. But moving on. In Australia, we had jobs data, and it's another mixed bag of numbers and different interpretations. The headline employment change was a decent positive, up 38.5k versus just over 22k expected, turning around the negative number that got a bit better in the revision as well. However, all the gains there went in part-time employment. You can see their full-time employment dropping, so that makes those gains a little bit less rosy. You'd like to see all those going into full-time employment, but as usual, can be a bit of a revolving door. What was a bit more negative was the unemployment rate was expected to come in 3.9%, but again there was another revision. It actually came in higher, 4.1%, 2 pips. That's quite a reasonable rise in unemployment. However, a lot of that, I don't know how much of that, was probably due to the participation rate rising as well. So there's a bit of noise in that number. I've seen a few commentators saying that this is a bad jobs report. I don't think it's hugely great. Well, I don't think it's overly bad either. When you're getting job gains, be it part-time or whatever, then that's better than having job losses, wholesale job losses. But that unemployment rate, we'll keep an eye on that over the next report or two to see if it's the start of a trend or something like that. But again, for the Aussie dollar, there's bigger fish being fried at the moment. But certainly that there's no heat, I would say, in the jobs market at the moment, which is something the RBA will be keeping a close eye on. RBA's Hunter was out. He was saying that there's no quick fix to Australia's shortage of housing and rising rents. He says upward pressure on rents and house prices will remain until new supply comes online. As you can probably guess, he was talking about stability in the housing market, which of course is something the RBA will keep an eye on because obviously rising rents, rising prices all plays into the inflation picture, and that's something they'll keep an eye on. A reason why they might stay higher for longer, just to put some pressure on that side of the economy as well. The Eurozone or the EU Commission was out with their latest forecasts. They see inflation dropping faster than they did in their winter forecasts. They now see 2024 inflation at 2.5% versus 2.7% previously, and 2025 down a pip to 2.1 from 2.2%. So that would be a bit of music to the ears over at the ECB that the Commission expects inflation to be coming down or continuing its drop down, though usual caveat about institutions and their forecast stands. We did have a sources piece out from EconoStream saying that the ECB Governing Council is very cautious on rate cuts past June, but they wanted to stress that caution should not mislead anyone into questioning whether they are going to cut in June. The source said among the worries is the Fed stance bringing some additional inflation to the Eurozone. So all eyes on the Fed once again, but it does sow some doubt as to what's going to happen after June. It should be pretty much taken for granted, unless the data does go the wrong way, that they will be cutting in June. And as we've been saying for a few weeks, the question isn't about June now, it's about what happens after June. Are we going to get another quick cut? Or are they going to be very cautious about when they cut next? That's going to affect the euro when we find that out. Over in the US, all that ton of data we've been waiting all week for finally dropped. Again, it's very messy. Well, the market reaction is very messy. So inflation came in line in the main numbers. Was expected to fall to 3.4% in headline CPI. It did. The core was expected to come in at 3.6. It did. Even the monthly numbers coming in pretty much in line as well. So confirmed a small drop back in inflation. Remember, this has been going high a little bit, so a bit of a minor win for the Fed. But again, we've seen a big reaction in the market. That's probably in part due to retail sales, which came in flat on the headline number and negative on some of the other numbers. The control group, which is core sales, ex-gas autos, also negative. It's all small numbers, though. You know, this retail sales can be a bit volatile. It's a soft report. Is it a disastrous report? No, but again, like jobless claims last week, you wouldn't know it with the market reaction. You know, dollar getting trounced again, yields getting trounced again. Match that up with the CPI going the right way. The direction's okay. I still feel like it's been a bit of an overreaction, but as we've been saying for the last couple of weeks now, the market wants to smack any cracks of bad news. There was more bad news in the Empire State, down 15.6. Not a huge number, but it's another negative number for the market to jump on. Some of the components there as well looking a bit softer. Earnings front as well. Again, some negative numbers coming in there. So we're seeing earnings looking a bit weak as well. Another fly in the ointment, shall we say, for the Hawks. There was the year-on-year numbers for real average hourly earnings came in at 0.5 versus 0.6 previously, so a little bit softer. Average weekly earnings year-on-year, the same numbers, 0.5 from 0.6. So again, a little bit softening. Business inventories after that, I said this one needed to be watched this week because it can show signs of slowing activity. That came in at minus 0.1%. Retail inventories, this was a revised number, came in worse, minus 0.2. Not sure why it's green. I have no idea, but it was 0.1% in the initial number. So that's worse too. So again, this is all tepid weak data in my opinion, but the market is doing what the market wants to do, and it wants to whack the dollar and get all dovish over the Fed. I assume you've had a good chance to review all the data yourself, mate. What do you make of it?
Yeah,
it's not like we're heading for a recession tomorrow, is it?
Yeah, I think the kicker is as always has been those. I'm not going to call them secondary data because they are important data, like just as like the retail sales or all those claims. But yeah, I mean, I don't think on the headline inflation or the inflation data it warrants a dollar sell-off. But it looks like that what's bubbling under the surface, all those secondary data are showing a bit signs of weakness. And as I've been saying as well for weeks now, the market is ahead of every data point, is now looking for the pivot to have the green light to sell dollars. But it's also, a lot is also due to the fact that the equity markets are so buoyant and trading so positive, and the correlation says that that is usually a bit negative dollars. But we did see the yields come off as well. Now the twos have given back quite a bit, and even the tens have given back quite a lot. So you can't really fight the bond and the equity markets, right? When you're trading FX and but all things considered, FX is still, yes, we had pretty big moves on the dollar yen, but the dollar yen has always been like very volatile or the past year or year or two even. But if you look at the rest, the positiveness that you can see in the antipodians, positive that is filtering through in stuff like the sterling, for instance. It's all still one pot of net. Looking for the the pivot in the dollar probably, but I'm still not overly convinced that that the dollar should weaken because of those data. It's actually more, yeah, slowly weaker data, but it's as I've been calling also for a while, the slow a slow grind lower in the data is going to be taken as a positive soft landing because things are not crapping the bed. And that's what this market is trading now. And I still think overall we are in ranges on the euro dollar, because let's not forget ECB is going to cut the first. So I have a hard time to see this euro dollar really run away. And the rest is a lot of correlation is on the positiveness of equity markets and better doing bond markets. So and that really filters through in most of the crosses, I would say. If you look at stuff like, for instance, the yen crosses, they come back a little bit, but then on the first retracement levels, they already rebound. So that is still a market that trades it positively. So if you want to be short dollars, fine, but choose your dollar wisely. Still, I'm not convinced that euro is the best one to be short dollars against. So we're still in that, what I was saying, this messy Q2 where things are perhaps turning, but perhaps also not yet. And then money goes to work in stuff where it's the easiest, let's say, for the big money, not for us retailers. We are like 5% at best of the market. But if you look at the stock markets, there's still a lot of investments there. The bonds are coming back. So and FX is a follower of fashion right now.
Yeah, very much so. I agree with that, and I think it's difficult because this seems like one of the moments where, yeah, maybe the market is going too far on what is, you know, mildly missing data. You know, nothing showing that the US economy is going to collapse. Of course, can things get worse? Absolutely. Can data get much worse? Absolutely. But if the market's moving like this on tepid data, imagine what it's going to do on real bad data if we get a stinky NFP next time up. I dread to think what's going to happen. But it's not. It's not.
We'll probably see the opposite, because if you look at the correlations that we are seeing now, okay, not in the bond market, but if you really get shit data, then you might see the equity markets all of a sudden turn around, and the first thing that they are going to do is to buy dollars, which is the wrong trade.
Yeah.
But that may be the first reaction, because now clearly the market is versus the other majors is selling dollars because the equity markets are doing so well. But if we really get shit data, then yeah, the first reaction may actually be to send the euro dollar lower or so, but that's going to be the wrong reaction, I think.
Yeah, no, exactly. And then, as I say, I think any other time I might think of fighting this overreaction, but it's going, because it's going the way that the Fed are leaning anyway. I'm not willing to fight both the market and the Fed at the moment. Plus, I'm also positioned on the right side of these moves, so that's stay in my hand another time. But we're still in pendulum swing mode. This could all change again. We've seen it time and time again. This could just be nothing but walking to the edges of some well-known ranges before we run into trouble. But we'll look into that when we look at the prices in a little bit. So anyway, after all the CPI data, there was a bit of a firming up of Fed rate expectations for cuts for September and December after the data. And again, we're seeing a knock-on, whether it's by design or just mechanical, that when we get US data and moves on Fed expectations, pricing, we're seeing other countries' central banks also seeing changes in pricing. So UK rate futures now fully priced, or did after the data, fully priced in 2 25 pip cuts by the BOE by November. That was only slightly up from 47 basis points, I mean, at 50 basis points. But again, it just shows you that there's a bit of a knock-on that can happen via other assets to do with rates. Fed's cash and carry said Americans have been spending more than he would have expected, and that the housing market has been more resilient than he expected. He says the big question now is how restrictive is policy currently. Says we probably need to sit here for a while longer to figure out where inflation is headed. Fed's Goolsbeast said that if the decrease in housing inflation seen in the April CPI continues, that's great. But he says we need several months of good inflation data to be happy. Over in politics, and we've got ourselves some fun coming up this summer, folks. El Presidente offered to debate Trump with some terms and conditions. Trump agreed. So it looks like we've got two one-on-one debates happening, one on the 27th of June and the next on the 10th of September. So dates for your calendar. That's going to be epic watching, just for entertainment value rather than what's going to happen. I can't wait for that. So, as I say, should keep us entertained through the summer. Microsoft are apparently asking hundreds of their China-based AI staff to relocate, according to the Wall Street Journal. This is to do with the ongoing US-Chinese tensions. They want to get some staff out of Chinese areas there. So maybe that's something we need to keep an eye on. And then the terrible news yesterday that the Slovak Premier PM who got shot is still in a serious condition but has stabilised. That was a headline that came out yesterday. Just something to keep an eye on as well for reasons why and whatnot, but we wish him a speedy recovery. That's it on the headline front from Wire. Kay, I don't know if you've picked any bits and pieces up the last couple of days you want to bring to our attention.
No, I think for today you covered most of it. I've also seen those debate scheduling, and I was going to say, yeah, mark it in your calendars, because we know that on the first partials for the conservatives in the US, when Trump got that victory, that stuff like the mix and things and Rand and even China were on the move then. So I'd really would mark those dates in your calendars, because that is something that emerging markets will keep an eye on as well, because we all know what could happen if he comes back. Although Biden has already made good work of quadrupling tariffs on some Chinese products. I've seen, by the way, that China is speeding up deliveries or shippings of goods to enter the US by Mexico. So they are trying to sell most or a lot of their products before the tariffs kick in. So yeah, those things are really to keep an eye on, because they can make the emerging market move a little bit. Yeah, lots of articles and opinions about what's going to happen in South Africa for the election later this month. Seen the rand is on the move. I'll probably, if I have the time, I'll show the rand quickly today. It's still a bit early to really point to what is going to happen with the rand, but we see the market trading it quite positively right now, and so I'll have a look at it when I get the chance.
Yeah, no worries, mate. I'll leave that one to you. Right, so let's have a quick butchers around what's gone on. I'm going to start with cable. Now, I mentioned this one yesterday. If you want to take a bit of a wider look, there was a bit of a range to play, 123, 127, and look where we've knocked our head, 127. Does this mean we're not going any higher? Not at all. It just means that we've hit a bit of a pause level here. So the price action over the next few sessions is going to be important. Are we going to pull back significantly, maybe to 126s, or are we just going to find a bit of support and keep tapping on this level, maybe looking to break it? We have done a lot. Okay, that's the general consensus from a few of us in the room. You know, if you take it from these lows, Bank of England lows last week, you know, we've done, 250 pips odd since then. So that is quite a lot. And as I say, when the US data hasn't been really bad, That's why I think it's a bit of an overreaction, but also why this may have been a potential stretch point for these moves. You know, we've come through that now. It's going to need something more to get us going higher still. We got initial jobless claims today, which everyone's going to be keeping a closer eye on than they normally do after that little wobble last week that everyone jumped on. We've got some price data, import-export prices. We've got the Philly Fed manufacturing. We've got housing starts and permits. So the focus on data has, you know, stepped up. You know, even small misses are being hit. So, you know, don't get too complacent about watching the data now. You know, if any little bits and pieces that don't look right, then we probably continue. But I think this data could be a good test for something like cable. We're up against this level. If we do get softish data, if we don't get through 127 and crack on, then that's going to tell a story all in itself that perhaps yet the market has gone as far as it wants to go for the moment. So this one, like a lot of pairs, same with euro dollar, it's about, we've had these gains, can it keep these gains? And for us traders, it's where is it going to start showing up that it's going to start keeping these gains? For euro dollar, my old zone, we resisted it on the way up, blasted it through the data, got through the top. Now we're just asking a question, are we going to hold on the top? If we hold on the top, then we're probably going to be up for another run to the 109s. But again, what this does over the data is going to be important. If the data's soft, but we can't get back up to these highs or even have a good crack at 109, then, as I say, perhaps we run out of steam for a bit and then we may see a bit of profit taking and a bit of a pullback. So if you haven't been on these moves, this is where you've got to be careful. You don't want to be chasing it up here. And I said that right after the data. You don't want to be chasing these moves because you might find they run out of steam. How much is all that data worth? Is it worth 200, 300, 400 pips? I don't think so. Not the state of the data at the moment. Aussie dollar as well. Similar story. We had a push up. Just managed to nudge through the 67 big figure. But couldn't hold it. Now we're down messing with this zone here, old zone 60s, 80s. We're just creeping around, trying to hold it, not really. So look at the bottom of this zone first, 66, 60s. But I think this is going to be our important level, 66, 40, 50, where we had all these prior highs over the last few months, couldn't get through. So even when we did break, it was still a bit wishy-washy. But if we come down here and hold it, then that's going to be encouraging for all the longs, at least for the last couple of weeks. So that's going to be my important level for the Aussie dollar. Back below there, and we're back in the box, I think, from there. Who was looking at gold? I'll have a look at a couple more, then bang it over to Mr. K. So gold, we knew where the level was, 2,400, can't get through. So still undecided what it wants to do here. This was the big level, 24, and we're not getting through. So all that data, everything we come through, it's still not getting through. That's maybe a bit of a warning signal. But how far we dip to is another question. If we find support of this 2360s, that's going to give the possibility of a break. It's going to keep that alive, that we may get a break. And then is it a break that we can hold? If we get a break this time, it's going to be different to these breaks, which were Iran-Israel event-driven breaks. So this will be more of a fundamental type break, if you like, and that's something that may have legs and get it going higher. And stocks as well, S&P. It was looking up, was it going to break? Will it break? Won't it break? You know, we came up to the level. It's just come down in a shorter time frame. So we came up to the prior highs, tried it once, tried it twice, tried it a third time, and then boom, it broke. So off we are again. Now we've got to do all the level watching, see where the levels and lines are all going to start popping up, just the same as I was doing all through the move up and the move back down. So we've got a break. Can it sustain it though? So you know where your pain level is now. It's down at the break point, 52.80s. If we get back under there quickly, then that's going to look a bit of a fake out, and all the hard work has to be done again. Come down here, test and hold. Might be a bit of an opportunity for a long trade off of that level, tight stop. See if we then continue further highs. Right, Mr. K, we've missed your charts for the last couple of days, so I shall pass it over to you.
Alrighty, thank you.
There you go.
Yeah, just okay. First of all, I am because there's been a bit of a Marcus here wants to have a look at silver. So let me look at the silver first. So first of all, the very long the long-term stuff. We're still above this, and that's where we held basically on the long term around 26. Yeah, the last move lower. So the long term is still extremely positive. But we are, if you look at the shorter end, so if you look at the very long term, this move lower here is the 50% is 30.5. So once we start to break above 30.5, then we're off to the races, I think. But in the meantime, we are capping around the roaring kitty high, yeah? The Reddit high here that we saw around $30. We're still hesitant, still trying, but we are not yet breaking. We can close again, but we're not yet breaking. So respect this 30.5, I would say. Yeah, I added some the other day around the 26.30s here. Let a bit go around here, then a little bit go actually this morning around here as well. Now I'm waiting to see whether we are again going to consolidate this this range, this move, or whether it's going to break. I think if it breaks 30.5 and on a close we close above, then I think we can really thinking of pushing higher up to 33s for a starter, and why not higher. But in the meantime, first things first. And as Ryan already mentioned as well, the 24 is capping on gold. If you look at any downside to hold, I mean, the very short term is going to be 23.70s. You see that as well here, and then 23.5. Okay, before we talk again about this activity zone here. But in the meantime, these are your levels of support here on the gold. What else am I looking at? Okay, euro dollar. Yeah, we pushed higher, as already said several times. We pushed higher, but we are 109 here. 109 is still good enough, I think, to keep an eye on. It's also the 78.6, sorry, of the move down from March to April. So 109, I think we can still see a bit of activity. If we get more negative data, and the claims may be enough this afternoon, but are the claims going to do this last little leg if they come out a little bit on the weak side, so higher claims? We also have housing starts, the Philly Fed at the same time, so capacity utilization, industrial production later on. So those are data which could trigger a move to 109, and then we will see where we close. If we close above 109, then I think we can push further up closer to 110. But it's going to take a break and hold above 109, I reckon. In turn, if we start to go back below 108.60, 65 and hold below, this move may be enough, and then we may be entering a consolidation move, which may take us back to the 108, the figure. This is sort of a move that I'm kind of looking at, but for the moment, we still have to wait for the data to confirm this, all right? I was just going to show this yen, but just as an thing, 153.60, 153.60, 153.5-ish, 153.5-ish. It's starting to build a little bit as a level, I'm going to say, for those watching to the downside on the dollar yen. It starts to bounce from those levels. Yeah, we held there before the bounce. When we kicked through, we did a load of stops. Of course, 152 is still going to be the big level, but when we're looking for levels in between, we need to see where it stops, and 53.5, 53.60 is where it, for the time being, stops. All right. And we see exactly the same thing on all the end pairs, really. They're all coming back to retracement levels and then bouncing. That tells me that we are still not in a completely reversal for the yen. This yen is not yet reversing, right? We may have to wait for another month until the next Bank of Japan meeting if Ueda comes up with a surprise. I was a bit surprised. When was it? Yesterday early morning or yesterday? Yeah, very early morning when Suzuki said that he was watching the JGB yields. I mean that is kind of shooting in one's foot, right? Because if you're already starting to monitor the JGB yields for not going higher or finding levels where they should be capped or so, I mean, then what is your expectation for yen to strengthen? It's impossible for the yen to strengthen if JGB is already going to be capped, right?
Yeah, it
That
was a
was
bit
a
of a
very
bonkers
strange
thing.
comment I found.
Yeah, maybe some translation there that we don't know
Perhaps.
about.
Perhaps, but that was one very strange comment that I picked up on when I was off. Anyway, yeah. So now the 155 figure 10 is back on the radar, and then 156, 156 and a half after that. But yeah, for the first level is going to be around 153.60, 153.50, I think, and the yen crosses are all looking the same way. Canadian dollar yesterday. Sorry, I was looking at this kind of especially the trend line support. We dipped below, but then I had this extra level here, 153.90, and we tagged it twice over the course of yesterday and very early this morning when the dollar was selling off a little bit. And it's holding, and we are trying now to get back above the trend line. I'm a tiny bit long. Just playing off this level, actually. I thought this would be possible, a bit of a stop run, and then see if it holds this line, and it did. And so this is now my line of defense for the dollar Canada, or line of support, if you want. And for as long as it holds there, I'm going to try to defend a very small position and see what happens. I did pick it up around, where was it, 136.17 or so. Sold out a little bit on the bounce that we had back here, and then now I'm keeping a very small position in it. Elsewhere, Swiss pairs. I'm less euphoric on Euro Swiss, I must say. Keeping the ECB in mind, but also we've come a very good we've come a fair way in trading the positive equity markets and stuff, and we saw that Euro Swiss could not reach those prior highs. So I've reduced my Euro Swiss longs this morning again, and I'm keeping it very small because I'm still bearish on the Swiss franc, but rather than Euro Swiss, which really needs to break above 98.5 to keep on going towards parity. I'm only keeping like a very small base position right now, and I'm just watching to see if we can get back down here or even a little bit lower, depending on what the euro is going to do. It's more of a euro play, this one. Sterling Swiss has done the same thing. Sterling being a currency that also trades the positive vibes or negative vibes in the market, has come. That was earlier, very early May, then came back down, starting to push again. But also here, this zone here, really for the move to continue in the longer term, this is a very strong resistance area, which starts around 115 all the way up to nearly 116. And I've also lightened up my position a bit, which I put back on around here the other day. So I've let a few go, just because I want to respect the medium-term importance of this zone. So I'm still not giving it up. I still think Swiss has a bit more to weaken, and sterling is doing pretty okay. Euro sterling is not running away either. But I'm going to keep a very close eye on risk as well. If stocks start to turn, that may be one that I let go as well. But all else equal, I'm going to be looking for moves back down to mid 113s, low 113s to rather reload instead of keeping the full position for the move higher. Yeah, I can look at the sterling cat. I actually have it. I actually have it on. Okay, I'd call this a break, right? 171.90-ish, right? This is a break. Enough touching points on a trend line, goes through it, and it holds and it continues to push. I think it's not a bad one, but there we are going to have to hold to be really very positive. We need to. It would be great if we have a retest of 172, the figure 171.85. That would be a great retest, and then continuing to push higher. Okay. If we get above 172.90, then I think we are in for a retest of those March highs here. Okay. And it would also be very important because we this is a level from 2023 as well. So if you start to push above this 173, 40, 50, that's going to be very, very impulsive, I think, Michael, okay? In the meantime, shorter term, I think this is a break, okay? But then if one would buy dips, I think you've got a level here, which has looked like a bit of a springboard around 170, 165, 70. Goes back down there, then I think we may be in for a bit of a failure and a move back down. Okay, but this looks like one where it's worth a go around here with a stop below here. This is how it looks to me right now. This sterling cat. And I said that I was going to look at what's happening in the rand. Yeah. We've broken below the trend line. Well, we've broken once, then we rallied back up, but the middle of this range here is this really looking like a pivot area right now, 1870s, and then we started to go back down, broke it back down, retested a little bit, and now we're down here. There's still this market is looking forward to those elections, right? That we have at the end of the month. And it does look like there is a potential of a positive coalition there coming in. Even if the ANC loses majority, there is the potential of a positive coalition. But I'm really putting the rand trading on hold right now. But what I'm really thinking about is that they are not going to be able to solve with all the promises they make. I don't think they will be able to solve all the issues in South Africa. Then why we are also trading the positiveness in the rand right now is perhaps the hopium that China stabilizes a bit, and then we have like positive equity markets. It's an emerging market currency, still with a high yield. And all of that comes into play. But I'm going to keep a very, very close eye on the result of those elections for one, and then see if this is not one big, well, sell the rumor in this case in dollar rand, but buy rand rumor, sell the factor coming up. And I'm starting to have a feeling that this may be what is going on. If we get more strength in the rand into the end of the month, I'm going to get very, very, very interested. Okay, because I really think we are building a huge buy the rumor, sell the factor here in the rand. This is my view for the more medium term. What else, guys? I was going to look at quickly on the Aussie. I've got a few trend lines here coming in from longer, and they're coming in above 67. So 67.20, 67.5, 67.65. I think there's a bit of a zone here that's going to need to break for the dollar to continue to weaken, or for the Aussie to continue to strengthen on the other side. Okay. There was one interesting one here also that I caught up on over the past couple of days. This channel in Kiwi has broken them. 60.70, the channel on the Kiwi has broken, and we reached the next, and this I think is a bit of a this is an important resistance area. 61.40, 61.55, 40.55, 61.40.55. We also see it from past trading that it has been an important level. So we've got a very nice range here defined for what's to come next in the Kiwi, I think. So the top side 61.40.55, downside 60.65 up to 60.75. Okay, the trend line is going to come down a little bit, so we are going to have to stretch this downside zone as time goes on. But we've also seen that zone already pop up in the past as well. This attempt and then failure. So this 60.65.75 I think is going to be important as this 61.40.55, and that is putting the Kiwi back on my radar. I haven't been trading it for quite a while, but this one now is starting to look very interesting to me for what is to come. All right, I'm sort of where what I perhaps a quick one on the dollar Swiss. Yeah, the dollar Swiss is you know, I showed this one before. Market went for a walk back below the trend line, back below the 23.6. It does appear that it was just a stop run on some dollar positions, because we are now already back above those spike lows. We are already back around those trend lines. I think if that line here gives way back above 90.30, this may have been your washout, and we could start to rally. I tried a bit of a long, went out this morning, but I'm already thinking of buying a break here again if it would go, okay. Bigger levels to the downside are still a while away. This is going to be an important one if ever this goes back towards that 89 zone on the dollar Swiss. But first things first, let's see if this is a fakey and we start to get back higher. And with that, Ryan, unless anyone else wants to have a quick look, I'm giving it back to you, mate.
Thank you very much, mate. I will go back quickly just to, as Michael was asking about dollar CAD as well, and I know a lot of people trading the loonie at the moment. So I'll just grab that back. It's looking a bit weaker. We keep having these tests of the big figure. We've had a couple of pokes below now. So for me, we're definitely knocking on the door a few more times than we need to. The bounces are looking a bit weak as well. We had this sort of safety net under the 136.50, around the 136.30s, and we're breaking that. We've broken that. That's going to be the first level. We don't get above there, then I think we've got further downside coming. I think this is a bit of maybe a bit of a twin zone here, because we've got this 35.80s that we're bouncing off of. But as you can see, this 36.15, 10.15 has been a bit of a level. Then we get down to 35.5. It's been a bit of a level, and we've had some messing around in the middle at this 35.80s. So I think probably takes it a bit of a zone. But if we can't get above here, I think the loonie's in a bit of trouble, and maybe we're going to be seeing some further downside. But this is a big, strong traffic area, so expect plenty of to and fro in that point. But yeah, we could be making a way or setting up for a move, maybe down to the 35s and down to this next zone down here. So that's the view on the loonie, and that we'll call a day. Thank you very much, ladies and gents. Have a good one. Welcome back again, Mr. K-Man. We'll get stuck into the data today, and we'll update you all tomorrow. Have a great trading day, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.